and today we are going to cover one of the specific issuing securities event, which is known as the initial public offerings. So the initial public offerings belong to one of the types where companies issue securities to raise capital. However, this is special because you only have once as a company for your lifetime. So this is an initial public offering, which means this is the first time that a company raise external equity capital from the market, and the public investors for the first time they can buy the shares of the company. On the other hand, the other offerings after the initial public offerings are often called as seasoned equity offering because they are seasoned in that sense. This is not their new time, or this is not their first time. So the seasoned equity offering is a equity sellings for the second time, for the third and fourth, and it goes on. And one thing that you have to realize in the IPO is that we often see IPO underpricing in the initial public offering. The underpricing means that the stock's initial return could be abnormally higher on the first day in the stock market. So let me show you some patterns here. So this is a statistical graph showing the results of the IPOs in the United States. So starting from 1960s to 2020, and we can see that for the most of the cases, the average first day return is somewhat positive and they are very high. So if you compare it to a usual day return, the average day return is only about 1 or 2%. So this is very huge because sometimes you can even see that the initial return, the first day return, is even higher than the 50%, which means if you invested in $100, then you will immediately get $150 by just putting the money for one day. So this is very huge. So why does it happen? And why does it call this as underpricing? So this is called as the underpricing because of this let me draw a graph about the stock price following the days after the IPO. So this is the IPO day, and that is the first day where shareholders or the investors can trade the shares of the company. So the existing shareholders can sell their shares and the new investors can purchase the shares from other investors. And let me say that the stock price begins here, and in the previous class we talked about the offering price, and let me say that the offering price was here. So this is the offering price, which is the beginning price for this trade of this stock, and just in a single day the stock price returns are very high, which means the stock price becomes something like this. Something like this, and we can plot this here. So this is the return of this investment. So if I had the IPO stock at the beginning of the day, and then in the next day I can earn some money. So that's the meaning of the huge initial return. And then why why do we call it as a underpricing? This is underpriced if we believe that this new stock price is more appropriate. So let me say that this is more appropriate or adequate, and then compared to this new stock price, which is observed by the stock market participants, the original offering price was somewhat too low. So in that sense, we call this huge return as the underpricing. So in other words, it means that so the basis of this argument is that in the stock market, the companies are fairly priced. Maybe you have heard about the efficient market hypothesis, which means in the stock market, everything will be fairly valued, which means the stock price are what they deserve. So the stock price are measured and analyzed by many participants such as investors, analysts, the investment bankers, and everyone else. So therefore, we believe that the stock price are the results of these arguments. So we believe that this is more closer to the true value of the company. But on the other hand, the offering price was too low, which means at the beginning, in the IPO process, the offering price was set too low. That means the underwriters were trying to set a lower level of offering price. So in that sense, this is called as the underpricing in the IPO. So if we collect the statistics about the IPOs, and if we classify them into decades, and we can get this kind of results. And as you can see, there is a significant level of first day return. For example, in the 1960s, we have average first day return of 20%, and in the 1990 to 2000, we have even higher, which is 64%, and for recent periods, we still observe 17% of the first day return. So then what is the effect of this underpricing? Sorry, before that, this is the previous statistics is from the United States, but the rest of the world have the same pattern. So for example, Korea was here. So the Korea just below at the first column, you can see that Korea has average initial returns of 59%, which is almost double the price from the offering price to the new stock price. So what is the reason? Sorry. Before that, let me talk about the effect, the subsequent consequences of this underpricing. So if the offering price is low, that means the company will raise smaller amount of capital from the IPO, because the proceeds from the IPO is determined by the stock price, the offering price, times the number of shares sold. Therefore, because the offering price is low, it means that actually company cannot raise what they have wanted, but actually they would get smaller amount of money from the market. So from the point of view of the selling corporations, this is a disaster, because with these money raised from the IPO, they have to invest in a lot of projects, but due to the underpricing, they were not able to do so. So therefore, they want to eliminate this possibility. But on the other hand, they were forced to do because the underwriters come and say that your offering price is too high, so we have to set a lower price. So this is a result of the bargaining between the selling company and the underwriters. And then why does the underwriter want to have a lower offering price even though they know that maybe they will succeed in the stock market and the stock price will become higher? So that could be the reasons why they are doing so. First, for their defense, finding a fair price in the IPO is very difficult because this is the first time where the company will be listed in the stock market. And if a company is listed in the stock market, then everyone can find the information about the company through their public filings. But on the other hand, before that, before the IPO, the company was not in the stock market. Therefore, investors had no access to the internal information. So it is very difficult whether this company is very valuable or less valuable. And because of that, we have a kind of information asymmetry between corporation and the outside investors. And outside investors are worrying about the company's true value. Therefore, maybe they do not want to purchase the shares at the beginning, at the IPO process. So, to alleviate these concerns, the underwriters try to have a lower offering price so that investors still feel that this company has the stock for this company has a kind of it is worth of investment because it is very small, it is very low price, so maybe we can purchase this and sell at higher price. And by doing so, this underpricing can lure the investors from the stock market to the corporation. And as an evidence, we can find that young and small corporations experience more underpricing, and those young and small corporations are the ones with more information asymmetry, which can explain our results. So here, we decompose the total sample into several pieces. So we have divided the companies into several categories based on their net sales, and you can see that generally for the companies with higher sales, the initial return is smaller, but on the other hand, for the companies with smaller sales, they have a higher initial return, so they are experiencing more on the pricing and they are experiencing less on the pricing. So therefore, we can argue from the perspective of the underwriters, this is the reason why underpricing is necessary. So this is to increase the demands from the stock market investors so that every shares could be sold to the investors. But on the other hand, someone can also argue that this is a intentional intention, this is due to the intention of the underwriters, because partially, at least partially, underwriter has some kind of incentives to do so. So for example, the underwriters were trying to give more returns to the selling corporations. They should have set the offering price higher because this is for their clients. But on the other hand, sometimes the underwriters have their own interest. For example, they also get the shares from the corporations and they can trade these shares in the stock market by themselves. So it is better for these underwriters to pay less to the corporation, and then later if it becomes higher, then they can sell at the price whatever they want. So for that personal reasons, hope maybe those underwriters are trying to let the selling corporations to set the offering price even lower, despite the fact that actually this is a successful company. So for the rest of this chapter, I'd like to talk about the valuation. So the valuation is very important in the process of the IPO for both investors and the corporations. From the perspective of the corporations, it is important to know the true value of our company, because based on our estimate about the value, we can raise the capital, and then the capital should be used for our investment. But at the same time, from the perspective of the investors need to know about the true value of the IPO company so that they can decide whether as an investor I have to purchase the shares or not. So I'm going to talk about the valuation in two different ways. The first one is called as discounted cash flow valuation, and the second one is called as the relative valuation. So let me begin with the discounted cash flow valuation, or in short, the DCF valuation. So the DCF valuation is a method to estimate a company's value as the net present value that we have learned previously in the financial management course. And here the cash flows will be free cash flows from the company, and we will use the cost of capital that we have learned in the previous chapter as the discount factor. So because we discount the cash flows from the company, that's why we call this as a discounted cash flow, DCF valuation. And then what is the meaning of the free cash flow? Sometimes you forgot what you learned before, and sometimes maybe some of you may not heard about the free cash flow. So let me explain what the free cash flow is. So the free cash flow, which is the term that we can find from the chapter 2 in the textbook, this is the cash flow that a company generates. So it earns, and then it spends some of the money to the reinvestment inside the company, and the remainder is called as the free cash flow, because there is no specific purpose or the designated objective for this cash flow, because we already spent everything we need. That's why we call free for this cash flow. And this free cash flow is composed of three components. The first one is the OCF, the operating cash flow, and the second one is the capital expenditure, CAP, capital EX expenditure, and the third one is here this symbol, the delta, means the change, and the NWC stands for the net working capital. So this is the change in net working capital. So in short, in brief, the OCF is the total amount of money that a company generates, and these two, capital expenditure and the change in the net working capital, is the reinvesting. And the operating cash flow is the cash generated from the company's normal business activities. So here, the term the normal business means that this is not a single term windfall or a one-time money that we luckily get. This is a ordinary this is coming from the ordinary activities that we can think about for the future. And the OCF here, the operating cash flow, is calculated from the EBIT, which is the earnings before interest and taxes. And then we subtract the tax from the EBIT because the tax should be paid to the government. And then we add back the depreciation. So let me explain why we need to add back the depreciation here. So this is an example in the textbook. So we have an imaginary company named US Corporation, and this is the income statement. So in the income statement, we start from the sales or revenues, and then we subtract some of the costs, for example, cost of goods sold, depreciation, and then we get earnings before interest and taxes, EBIT, and then we pay interest, and we pay taxes, and finally we obtain net income. However, the net income here is an accounting measure, which is not the actual cash flow that you earn. The net income is different from the real cash flow. So that is why we want to revise this income statement to get the true cash flow, and we start from the EBIT here, and we do not think about the interest paid because the interest paid is, although the accountants will consider interest paid as a expense or the cost, from the from the financial point of view, the interest paid is not the expense because this is given to the creditors who are one of our investors. So we do not care about the interest. And then we have taxes. We also consider taxes as an expense because this is given to the government. And then because we started from the EBIT, it means that we already subtracted depreciation at the beginning. However, if we think about the depreciation is not a real cash flow because the depreciation is a kind of accounting expression that your fixed assets value will decrease as time goes by. So actually you had nothing to do with the depreciation when you calculate the cash flows themselves. Therefore, because it should have not been subtracted, but it was subtracted, therefore we are going to add it back to get it back. So that's why from the EBIT we subtract taxes and then we add back depreciation. However, one thing I'd like to highlight here is that in the calculation of tax, this will be different from the actual income statement because the taxes amounts in the income statement is calculated on the base that you already paid the interest. So in other words, you have interest tax shield effect. So you had paid smaller amount of taxes due to your interest from your debt. But on the other hand, because now we are ignoring the interests, therefore we had to recalculate our own taxes if we imagine that this company had no debt. So therefore, in the calculation of the OCF, the taxes will be different from the actual taxes. So for this company, US Corporation, the EBIT is 694. So we start from there. And we recalculate our own taxes, assuming that we don't have interest. So because our tax rate is 21%, we multiply 694 with 21%, and we obtain 146 as our new tax paid to the government. And this is different from the actual taxes of 131, which we can find from the income statement. And we add depreciation back here to calculate the cash flow different from the income in the accounting, and the resulting operating cash flow will be 613. Right? So as I have explained right now, the interest expenses should be excluded. It should not be considered when you calculate the operating cash flow. So interest expenses are not related to the cash flows from the operations. However, this is related to the cash flows given to the creditors in the appreciation of their capital. And also, when we want to evaluate the company's value, we want to get the value neutral from the firm's capital structure or the financing cost. Therefore, we should not consider interest expenses in the calculation of the OCF. And then someone can argue that we also have to take care about the financing costs, but you don't have to worry because we will consider financing costs later when we use the cost of capital as our discount factor. So because we already considered every capital cost, the cost of capital, including the cost of equity and the cost of debt in the calculation of the cost of capital, and because we are using it as the discount rate, we are considering it. Therefore, in the calculation of the OCF, you don't have to do so. If you do so, then it is a double counting. Okay? And the second component in the free cash flow is a capex. The capital expenditure, or sometimes called as the capital spending, is the typical investment for the fixed assets. So it can be found from the changes in the fixed assets. So in the previous year, in 2020, the fixed assets was worth of 1,644, and now in this year, in 2021, it is 1,709. Therefore, the difference between these two values should be related to the capital expenditure, the change or the investment for the fixed asset. And then maybe you can calculate the difference between these two. So 1,709 minus 1,644. However, this is not all. You also need to consider depreciation. So as you can see, the depreciation is always causing problem in every calculation because depreciation is designed for the accountant's appetite, not for the actual, which is different from the actual performance of the company. So let's say in 2020 we had 1,644 fixed asset, and now in 2021 we have 1,709 fixed assets. So maybe you can think that the difference between these two, so this portion will be the capital expenditure or the capital spending because this is the new investment to the fixed assets. However, another problem is that actually some of the previously held fixed assets were depreciated as time goes by. So this the amount of this is 65. Therefore, actually, if you just ignore the depreciation, it means you are just considering this as the final fixed assets. However, now we have 1,709 including the depreciated value, which means the company had to reinvest to the depreciated asset so that it recover the value just before, and then in addition, there is a new investment. So therefore, you have to consider the depreciation again. So that's why in the calculation, you don't calculate only the difference, but also you have to add the depreciation to the difference between these two when you want to get the true capital expenditure. And the result is the $130 million. And the third component, last but not least, this is the related to the net working capital. And the net working capital means the difference between current assets and the current liabilities. And here, one thing that students often confuse is that we are not thinking about the net working capital itself. However, we are thinking about the change in the net working capital. So for the same company, US corporation, here the working capital is calculated as the difference between current assets and the current liabilities. The rationale in calculating the net working capital as the difference between these two is that even though you have this amount of current asset, some of them should be paid for the liability holders of the current liabilities. Therefore, some of them will be gone in later. Therefore, what you have is only the remainder. So that's why we are calculating the difference. And here in 2020, the current asset was 1,112, and in 2020, current liabilities was 428. Therefore, in 2020, the working capital, the net working capital, is the difference. So it is 1,112 minus 428. And similarly, for 2021, the net working capital is the 1,464 minus 389. And then we are again calculating the difference between these two net working capital in 2 years. So therefore, the change in net working capital is, first, you have to calculate the net working capital for 2 different years. The net working capital in 2021, the net working capital in 2020, and then you have to find the difference between these two. So as a result, you can have the change in the net working capital as 391. And then now we have 3 components which compose the free cash flow. Therefore, by considering 3 of them, we can calculate the free cash flows of the company, which is, because we had the operating cash flow of 613 and the capital expenditure was 130, and the change in the net working capital was 391. Therefore, the free cash flow is this one minus this one minus this one, which is 92. Now, you are ready to have the DCF valuation because you know the free cash flow. So, as an example, I'd like to talk about Feline Fancy, which is also another imaginary company, and this company makes cat toys. And for some reasons, investors want to evaluate the value of the company, so that's why we are doing this DCF valuation. And as a starting point, let me simplify the situation so that it will be liquidated in 5 years. It means it will operate starting from today, and after 5 years later, this company will be gone. So it will stop operating. So we don't have to care about the future anymore. And then we also have another assumptions. For example, the tax rate is 21%, and in the next year we need EBIT, depreciation, capital expenditure, and change in the net working capital for our calculation. And every other cash flows are projected and provided based on the pro forma statements. And this is given like this. So in year 1, the OCF is here, capital expenditure is here, and net working capital is here, and it goes on. So we have all information we need. And for each year, we have free cash flow as the OCF minus capital expenditure minus change in the net working capital. So it is 6.2, 7.13, 8.2, 9.43, and $10.84 million. And then because our assumption is that the weighted average cost of capital is 8%, it means we are going to use it when we discount the cash flows. So because this first cash flow occurs after 1 year, it will be discounted one time, and the second cash flow will occur in 2 years later, so it will be discounted twice, and the third cash flow will occur in 3 years, so it will be discounted 3 times, 4th time, and 5th times. So the value of this company will be the free cash flow in the first year divided by 1 plus 8%, which is the weighted average cost of capital, and the second free cash flow discounted 2 times, third cash flow discounted 3 times, 4 times, and 5 times, and no more, because there is no additional future for this company. This company will stop operating in 5 years, and you need a lot of calculation, but you can get help from the Excel spreadsheet or other program, and then you may eventually get the calculated result, which is $32 million approximately. However, a slight issue in this result is that this is correct answer if our assumptions are all fine. However, the first assumption is not realistic. So generally, we have a going concern assumption as we discussed in case number 1. So the going concern assumption means that we generally believe that this company will remain operating forever, indefinite times, rather than stopping at a certain point of time in later. So based on the going concern assumption, this company should be expected to operate forever, not just stopping in 5 years later. And then we have to care about the firm's free cash flows for indefinite times in the future. For example, we also need to consider the cash flows in 6th year, cash flows in 7th year, cash flows in 8th year, 9th year, 10th year, again and again. And this will make your calculations longer and longer and longer. Therefore, it cannot be done in reality. And to overcome this kind of limitations, we adopt a concept named terminal value. So the terminal value is the approximation of all the cash flows in the far future for certain point of time. For example, for this company, for this Fairly Fancy, we are going to think about the near future cash flows like this, but we are going to have a terminal value for the rest of the time, and we are just going to add the terminal value to your calculation. Then how can we get the terminal value? To do so, you have to remember the growth perpetuity. And the growth perpetuity is a kind of investment like this. So there is an investment, and the cash flows from this investment this year was C. So it was already paid to me, so I'm not going to consider it again. However, I want to think about the future cash flows, and the cash flow is expected to grow at a constant rate of G. It means so it will not stop, so it will go forever. However, starting from C, it will be, the growth rate will be multiplied, and the growth rate will be multiplied again, the growth rate will be multiplied again, and it goes on. So for example, if the original amount of money is 100, then in 1 year later, and if the growth rate is 1%, and I can get 100 times 1.1, and I can get 100 times 1.01 to the power of 2, 100 times 1.01 to the power of 3, 100 times 1.01 to the power of 4, and goes on. So the value of cash flow is growing. So this is why we call this as a growth perpetuity, and also this is called as perpetuity because it does not stop. So there is an infinite series in the future. And the result is very simple. The calculated net present value of this kind of growth perpetuity can be done simply by remembering this formula. This is C times 1 plus G divided by R minus G. So I'm not going to provide you with the derivation of this formula, but if you want to learn about this formula, maybe you can go back to chapter 7, chapter 7, yes, if I remember correctly. And then let me come back to our previous example where the falling fancy should be evaluated, and instead now we are going to assume that the free cash flow will grow at 2% indefinitely. And then the terminal value, because the last cash flow we estimated was 10.84, so we start from this. So in year 6 it will grow, therefore we will use 10.84, which is the last cash flow we obtained, and we multiply 1 plus G here, 2%, and divide this with 8% minus 2%. Here, the 8% was the discount rate or the cost of capital, so that's why we are using 8%. And then we can get $184.35 million as the terminal value. However, there's a tricky part here. So the terminal value calculated here is from the point of view of year 5. So this formula is the calculation for the future cash flows ahead of 1 year. And because we are caring about the cash flows starting from year 6, this is ahead of 1 year, so we are at the point of year 5, which means now we have to re-discount this to get the present value at the point of year 0. So the correct calculation should be done like this. So we have the same all free cash flows here. 6.2 year 1 free cash flow, discounted once. 7.13, which is the second free cash flow in year 2, discounted twice. Third free cash flow discounted 3 times. Fourth cash flow discounted 4 times. And fifth cash flow discounted 5 times. However, with the addition of the terminal value, because this is on year 5. And then the correct calculation, the revised calculation, gives you the value of Feline Fancy as $185 million approximately. And here, the value here is the aggregated value of the company. So it includes not only stock price investment, but also it include the value of debt. So therefore, if we want to calculate the stock price, we have to take care of the debt value. So if we obtain the V, the value of the firm, from the DCF analysis, and then we subtract the value of debt from the value, and then we divide this with the number of shares so that we can get the stock price per share. So let me give you an example. So from the previous example, let's say Feline Fancy had $40 million in debt and it has 3.5 million shares outstanding. And then the stock price is the value of the company we calculated, which is $158 million, minus 40, which is the debt's value, divided by 3.5 million, which is the number of shares. And then it gives you $33 and 3/4, 7.5. Okay, so in following these procedures, you can calculate the value of a company through the discounted cash flow valuation. And as you can see, the previous chapter, chapter 14 and chapter 15, is closely related, because if you do not know the concept of the cost of capital, then you cannot actually get the result, because in every calculation you need to care about the cost of capital, right? So therefore, that's why we learn chapter 14 here and then we learn chapter 15.